watching Morning at NTV.
All right, we're glad you are with us. For those that went with us into the break from that discussion on fundis and reforms in the building sector to ensure that we avoid some of the disasters that we grapple with. Talking about the issues that we grapple with, taxation is a given. At any one time, from time immemorial, you as an individual and as an entity of business are supposed to pay taxes. And in the last 1 week, news emerged that the Uganda Revenue Authority was rolling out a litany of new taxes as part of amendments to the various bills that are on the tables of members of parliament. I'll be introducing a tax lawyer who will be helping us make our way around the litany of these amendments so that we can understand how exactly it affects us. But let me just give you a preamble before I do that. Government has presented new tax measures to Parliament for deliberation in the face of mounting pressure to boost tax revenue collections from 25 trillion Uganda shillings projected in the current financial year that is ending on June 30th, 2023 to 28 trillion in the upcoming 2023-2024 financial year. If nothing changes or amendments are made by Parliament, the proposals outlined in the Tax Amendment Bill of 2023, the Value Added Tax Amendment Bill of 2023, the Tax Procedure Code Amendment Bill of 2023, the Excise Tariff Amendment Bill for the same year, the Traffic and Road Safety Amendment Bill for the same year, the Lotteries and Gaming Amendment Bill for 2023 still will come into effect on the 1st of July. That is a whole lot to chew on. Denise Kakembo is a tax lawyer at Crystal Advocates, and he's here with us in the studio to help us make sense of what Uganda Revenue Authority is up to and just how we can be in line. A very good morning.
Thank you so much for hosting me today morning.
How are you doing?
Very good.
Me?
Yes.
I'm taken aback, but I'm also convinced that revenue collection must be achieved.
Yes.
The how, the when, the what might matter, and that is exactly why we are here today.
Yes.
Tell us about the proposed amendments in tax and the replacing briefs for viewers to get a clear picture of what is at play right now.
I think building onto what you've earlier said, that I mean, you're shocked, but you're also cognizant of the fact that government has to raise revenues. I think the government also finds itself in that position.
That's right.
Position in the sense that it has borrowed heavily. It has a heavy bill in terms of repayment of the debt loans. It has salaries to pay. It has the development agenda to meet. And then for the last many years, the tax ratio to GDP collection has stagnated. So it also needs to increase the taxes.
That's right.
So the government finds itself in a position where it's got to balance between raising revenues, but also ensuring that the taxes it prescribes are tolerable to the business community, so that the tax does not actually shock and entirely affect business performance.
Okay.
Of course, there are many tax measures which have been proposed in the bills you just mentioned. I think there are over 40 sections of the law that have been proposed to be amended, but there are about 4 to 5 changes which are unsettling the business community. And I mean, there are good measures in there, as I will mention, but I mean, these 5 ones seem to be overshadowing everything else. And the question which comes to the fore of our discussion is whether a country can be, whether you can tax a country into prosperity. Whether they...
Wow, can we tax ourselves into prosperity?
So that's a key issue. Now,
okay, yeah, before you just continue, you said it's a litany, of course, and reading the amendment bills listed here, first of all, you could clearly see there were many, and I was grappling. But let's look at 4 or 5 contentious issues, as you've just said. Capital gains, the proposal to impose a final 5% withholding tax on all asset disposal, including chattels, regardless of whether profits are made or not, goes against the principle of capital gains being only realized when an asset is sold to more than its original purchase price.
Yes. Now, as the name suggests, capital gains.
Capital gains.
It's a gain on capital. So if I buy land today at 100 million shillings, and in the next 2 years I sell it off at 200 million shillings, it actually means I have made a profit of 100 million. But if I sell it at 80 million shillings, it means that I have made a loss of 20 million. Now, the law as it presently captures that position of the law, that when you make a gain or when you make a loss, you're not taxed. But the government is radically changing the scope of how the law works. And in this regard, if you sell off an asset, whether you've made a profit, whether you've made a loss, the government is going to tax you on the basis of the proceeds that you've made. So if you sold an asset at 100 million, the 5% of that would be 5 million.
5 million Uganda shillings. Which
is oblivious of the fact that, I mean, you're not looking at profit, the gain that I've made, which essentially is the principle upon which income tax is based. And then also, of course, from our Ministry of Finance, or URA side, when you look at the assets that are disposed, there are quite many. Previously, the capital gains regime as it works, it's only applicable to a narrow range of assets, maybe the land, but the proposed measure is now going to apply to every asset disposed of, including chattels. If you sell off chairs in your house, if you sell off a refrigerator, if you sell off a car, which has previously not been the case. Now the challenge, unless if you're selling off trading stock, if I'm in the business of selling cars and I sell off the cars, in that regard, capital gains will not apply because that's a business income. So the challenge with this is that, how is URA going to go into the local community and trace all those people who are buying assets? Because the way this tax works is that whoever buys an asset is expected to withhold the tax and remit it from the URA. So what that actually means is that already there is a burdened, narrow base of taxpayers who are on the rad of the URA, the people that file returns, the people who are in the formal sector. So this proposal is actually likely to affect those people more, because you know, if URA comes and looks at your books or it looks at your fixed asset register, you've acquired so many assets, they can ask questions that we see you've bought this car, we see you've bought this refrigerator, but we are not seeing withholding tax remitted to us. And that is going to increase the burden in terms of their compliance. But even then, a good tax is one that is fair, is one that is uniformly applied. I think in the premises of what I've just explained, we do not see that tax being applied to the local community. It's just a few who are going to suffer with.
That's a very huge challenge, especially when you talk about the local communities. People might not really understand how my purchase of a fridge and a cooler you know, has to quickly reflect on the other end when it comes to the need to be able to appease the tax band. Already there are compliance concerns that Uganda Revenue Authority is grappling with. And then the rollout of these particular new amendments that, if adopted, could present yet again another challenge. How do you see the tax body moving?
I honestly appreciate the pressure Uganda Revenue Authority is under to collect. But I'm also cognizant of the fact that a tax system should be easy to administer. So if you come up with tax laws, no matter how nice or how cool they seem, for as long as you're not able to enforce. So if you're going to incur a lot more money to chase after
people
so many
around
people,
to pay little or lesser tax,
then you lose the bigger focus. You're unable to go after bigger audits, bigger monies where you can get a lot more money. So from where I sit, and I don't think it's a good measure. Capital gains, let us not depart from the principles as they are. Capital gains is a tax that is taxed on gains. So I think the position of the law as it is should remain.
Now, there is the second one that is very contentious. Collective investment schemes described as unit trusts. How is that going to roll out? Now,
if you, I believe you've seen insurance agents come over to you because they've been aggressive in terms of promoting that product. Whereby you save money with them, and when you save money with them, every month you earn an interest of, I think, 1%. It's a compound interest. So at the end of the year, you find yourself earning maybe about 12%. And interest, and that interest that you earn is not taxed at all. So the collective investment schemes or the unit trusts have gained traction. I mean, in the last 3 years, when you look at the movement in terms of savings, I think it's now over $1 trillion plus. It's quite impressive. And of course, as a country, we've been grappling with how we can encourage people to save. And if the collective investment schemes have actually been helping that, I think it's something we have to look into. Of course, collective investment schemes, how they work, might differ from how SACCOs work.
I was just going to ask, there seems to be a gray area, especially when it comes to what we know best, and that is being pushed by very many government and business sector players, SACCOs and unit trusts.
Yeah, of course, SACCOs, you come together, you pool resources for investment. And when you look at the law, SACCOs are exempt from tax.
The kind of taxation.
Now, the collective investment schemes or unit trusts, I mean, the objective, the principle seems to be the same. Or operationally, it might be different, but principally, it's all about saving money so that you accrue.
Put it in a language I understand.
So that you generate some profit, some value.
Okay.
Just like SACCOs, how you pool resources and invest them. So I do not see any material difference in terms of the objective. The objective is about generating profits. So if you're exempting SACCOs from tax, I do not see a reason why the unit trust should not be exempted from tax. But even more to that, when you look at the law itself, I think when you look at Section 83 of the Income Tax Act, foreign lenders, in some circumstances, when they lend money to Ugandan businesses, and those Ugandan businesses pay out interest, there's no tax on that.
There's no tax on that.
The reason
but if the investors are local, there is a tax on it.
Yes, now you're applying a tax. And of course, the rationale for that was that because of the scarcity of credit, let us not tax the foreigner so that they bring the capital here.
But the logic, the simple logic is that the foreigner usually has a lot more money to be able to bring forth. So ideally, one would say, is that an incentive to have them bring in more money?
Yes, it's an incentive for them to bring in more money, but and this is where it comes through. Local investors have always complained that maybe the foreigners are favored over them.
Because at the end of the day, there is a capital flight. When that money, the profits are made and then all the money is taken out. Yet for the local investors or lenders, then if they pay tax on that, they have to again recoup that money into the rollout of the business. So
the unit trusts, if I could add further, have helped in revenue mobilization. Through savings. When you look at the statistics, the revenue saving base has actually improved. And in fact, what is quite interesting is that a lot of this money is invested in treasury bills and bonds. Bonds are issued by government. Government borrows from the public. So the people who are investing in the collective investment schemes are actually availing money to government. And when government pays you interest on the treasury bills and bonds, you already pay a tax of 20% withholding tax. It's a final tax. So what your collective investment scheme receives as a return has already been subjected to 20%. But even when that profit is being distributed to you, when it was already subjected to tax, when you're buying treasury bills, the government still wants to apply tax at the rate of 5% if you save less than 100 million, and 15% if you save more than 100 million. But again, also, if I am an employee, most likely the money I am going to put into the collective investment schemes is what I have retained after I have been paid my salary. That salary has already been subjected to pay as you earn.
There's a lot that has already been chopped.
So it's a bit, it's a multiple layer of so many taxes which is being applied.
So at the end of the day, these, this litany or rollout of taxes on the outside, it looks at business entities, but I'm seeing that the average Ugandan is going to be affected a little bit more, and they need to understand the how and the why. All right, let's look also, at...
I think before we move on, about the collective investment schemes, there's now a requirement that if you're saving more than 100 million, you have to file a return to the URA. Now, people are quite cautious about revealing their financial dealings and financial information.
That is right.
So if I have saved 500 million in my collective investment schemes, but my tax return is reflecting maybe 100 million, URA is going to come and start asking questions of the magic you use of only making 100 million shillings in business income, but you're saving 500 million. So I see a number of people pulling out of this and so that they do not have to make a disclosure.
Choosing other investment vehicles where to take their savings. And that, of course, effectively takes away the ability of URA to make that money. Now, the corporates in today's settings are very heavily invested in many of these unit trusts, either as entities within the confines of their workplaces or even industry dynamics. And what I see here, just like you said, it's a bit of a misnomer that you're saving 500 million, yet your profits are listed as 100. How are they going to cope, or how should they realign themselves to be able to survive in that?
What I see happening is that certainly the unit trusts are going to take a hit. People are likely to withdraw their funds, or they are likely to invest less, because the more information you give to a taxman, the more questions they ask. So you would rather avoid providing us so much information. What is not asked for, you don't provide it. Because when you provide it, additional questions are going to arise. So the unit trusts are going to be affected.
And that, at the end of it all, also affects transparency.
Yes, it affects transparency. And then also the government, I mean, if people are no longer buying treasury bills and bonds through the collective investment schemes, that means you as a government, because that's how you borrow money to finance your day-to-day business, even your income streams might be affected.
All right, there's another proposal, and that one is on tax losses. And if I can just read here, the government is proposing for the third time, apparently in under 6 years, to restrict taxpayers' ability to indefinitely carry forward their assessed tax losses. The new proposal allows for only a 50% deduction of losses carried forward after 5 years of making tax losses. But I understand that this has been rejected twice by members of parliament. And here they are again. It's on the table.
Now, the way income tax works, it's a tax on profit. And for businesses that are starting up, it's probably going to take you 3 to 5 years to break even. And start to be profitable. And if you're kind of...
That is if you're able to celebrate your third birthday.
Yes, that's if you're able. And then businesses like NTV or manufacturing, where there's a lot of capital investment, it's even going to be a much longer time period.
That's right.
Because whenever you buy machinery, in the tax language, that machinery, you have to write down the capital cost, the cost of buying the machinery. So the cost of buying that machinery, you might find that the revenues you're earning for the first 6 years are significantly less than the cost of the machinery you bought. So naturally, you will always be in a tax loss position. Now, it is not fair to tax someone who is in a tax loss position. I know URA has had challenges.
It's like you're being punished for losing money.
You're being punished for losing. And the question URA, which of course legitimately asks sometimes, is that, but why are you still in business?
If you're making losses.
If you're making losses. But, you know, book accounting losses could be different from tax losses. I could actually be making profits when you look at the accounts, but because of the earlier investment I made, like in oil and gas, they're going to spend maybe about $10 to $15 billion. So even if every year I am earning 1 billion or 2 billion, the payback period to recoup that investment I have spent in the 15 billion would mean that I'm going to have tax losses maybe for about 10 to 12 years. And it's not fair taxing that. Or limiting the ability to carry forward your losses so that government fast tracks its collection of income taxes. It's against the principle of only taxing profits.
The very next one, I'm sure, is going to unnerve many people, especially in the bailiff business, auctions. That is very contentious indeed. Just take me through that, because I'm also grappling to stay online when it comes to these litany of tax proposals by the taxman.
I think it's not only you. Even I, as a practitioner, I'm still trying to figure out how it would work and what exactly the intention of that was. Because who is an auctioneer? An auctioneer is someone who has been hired by a property owner to facilitate the process of sale of their goods. When you look at the banking institutions, they have a lot of bad debts and underlying securities, which are usually disposed of to ensure that they recover the loans that were disposed, and they usually use bailiffs. Now, this proposal, the reason why I call it absurd is it's substance over form. You just can't comprehend it, because you're saying if you help a bank sell off its property, or if you help an individual sell off their property, you, the individual who has facilitated the sale, you're deemed to have made the sale yourself. So you're deemed to have acquired that asset, and then you've sold that asset.
Yet you simply facilitate it.
So in auction fees, you might find that you're getting $1 million shillings as your fees for auction. Auctioning a property that is worth maybe $1 billion.
$1 billion shillings.
So URA is saying that when you sell a property worth $1 billion and you're earning 1 million
in fees,
you, in your return, because you're deemed to be the seller of that asset, you must reflect that asset of 1 billion, and then you must collect VAT at the rate of 18%, and then probably remit that VAT to the government.
Okay, that's a hard one, and I'm sure. What does URA's explanation sound like?
Now, my suspicion, and I think it largely follows through in the proposals I've seen this year. A lot of the changes we've seen in the acts recent disputes taxpayers have had with URA. With URA. I think late last year, Uganda Revenue Authority tried. They came up with a notice saying that unit trusts are taxable. And then they were confronted with the law and shown that they're actually not taxable. So now they've gone back and changed the law. Now, I recall about 10 years ago, maybe around 2019, 2009, 2010, there was a challenge with the financial institutions. Uganda Revenue Authority was telling the financial institutions that you have to pay VAT on the sale of foreclosed property. And the financial institutions were telling them that, wait a minute, these assets are actually being sold to recover our loans, which is a financial service. And the financial service is exempt from VAT. So I think in an attempt to circle around such items, if they're disposed of by banks, from being put in the realm of financial institutions, now it's being applied onto the auctioneer, because you as an auctioneer, you cannot say you're in the financial services business. But I don't think it will work.
We've covered the 4 contentious ones, but of course what I know is that looking at some of the documents that have been presented, and of course readings of the Uganda Revenue Authority, it's a whole litany of them all. Wrap this up in under 60 seconds.
But I think we've largely discussed the contentious side of it. But I think I would applaud the government for coming up with a formal voluntary tax scheme. So now, if you know you've not been very truthful with your tax returns and you have some issues to clear, please be encouraged to report to URA after these laws are passed, because you're going to be forgiven interest and penalties. So that can encourage compliance. It can also save time of URA going after non-compliant taxpayers. All
right, Denise Kakembo, tax lawyer with Crystal Advocates, many thanks for helping us wade our way around what is no doubt a very complicated and contentious issue of taxation. We shall be following that story, and the team in the newsroom, of course, will be giving you updates on sector players' reaction, and of course what it means for those that are in the businesses that are directly affected. It's been a pleasure having your company for the business update, and indeed morning at NTV this 13th day of April 2023. On behalf of my colleague, I should be able to break right now, and then we shall do our final rituals as we close. Let's go to our man on the ground out there. A very good morning. All right, let's break.